Good morning, everyone. This is Jason Masters from Athene, and I welcome you to our macroeconomics discussion with Professor Robert Shiller. Before we get started, a few quick housekeeping items to share. First, you'll notice that you are in listen-only mode, which means your microphones are muted for sound quality. There will be a short Q&A following today's presentation, so please submit your questions throughout, and we'll try to get to as many as possible during the Q&A segment. And lastly, today's webinar will be recorded and a recording will be sent to all registrants. Thank you so much, everyone, for joining. I will now hand it over to Lawrence Black, Index Advisor to Professor Shiller and founder of the Index Standard.
Thank you, Jason. Good morning, everyone. It's really great to be with you here this morning. So I'm delighted to be joined by Professor Robert Shiller. He is the Sterling Professor of Economics at Yale University. He is a 2013 Nobel Prize winner, and he's also a best-selling author and columnist. Professor Shiller, welcome this morning. It's really great to have you here. I mean, I think we've got so much to talk about. There's so much happening in the US economy and the global economy with high valuations, high oil prices, inflation, stagflation, the Fed, and what's it going to do and who's going to be in the Fed. So I think we'll have a great session today. What we plan to do is I will spend about 45 minutes asking Professor Shiller questions. And then at the end of that, we'll take questions from the audience. So Professor Shiller, and just to kick it off, I wondered if you could talk us through your CAPE ratio, how that came about, the history, and also what are the levels today and what are you thinking?
Well, this goes back to the late 1980s. I had a student then, John Campbell. He's now a professor at Harvard. He and I were trying to forecast the market. We were living in a time period back then when the word random walk was very popular. Burton Malkiel wrote a book called The Random Walk Down Wall Street, which says that it's impossible to forecast the market. But John and I were thinking back then, it may be hard to forecast what the market does tomorrow. But as you go further into the future, the force of mispricing becomes more and more important. So we tried forecasting at a 10-year horizon, and we found that we could predict substantial, not all of that, a variation in stock returns. When the market is high relative to some simple benchmark which we define, it tends to go down. Simple as that. And the benchmark that we took back then was a 10-year average of earnings. So if the price today divided by a 10-year average, actually everything in real terms, 10-year average of earnings is high, that means sometime in the indefinite future it won't do as well. And it's not, you don't have to be in a hurry to exit or whatever, but know that it's not going to be up to a performance. It caught on. People, I think it's better than the ordinary price earnings ratio because the annual earnings are too volatile. They jump around too much. If you want an indicator of the fundamental value, you have to take a longer average than that. And that had been done sometimes. Graham and Dodd recommended that at one point, or a 5-year average. The Wall Street Journal in 1911 mentioned price divided by 10-year earnings average, but it never caught on. I think that we live in an environment now where it matters a lot. Yeah. So, were you going to introduce this slide?
Yeah. So now we're showing the CAPE ratio, and maybe you want to take us through it. What you think about where valuations are today, Professor Shiller.
Yeah, so this is the evidence that Campbell and I found in 1988. Most people didn't look at long horizon returns. But we computed, we got data back to the 1870s. And that includes big events like the 1929 stock market crash. And we found that over this whole period, when the CAPE ratio, it's called CAPE ratio because it stands for cyclically adjusted price earnings ratio. When the CAPE ratio is low, unusually low, this is US data, the return, the annualized return for the next 10 years on average is about 14%. You can see that at the left. Can you point to the left bar?
Yeah, I don't think we can, but if you look at the left-hand side when the CAPE ratio is less than 10, you can sort of scroll up and you see it's about sort of 14%. So, you know, it's kind of what you expect when valuations are cheap, you get high returns. And then when valuations are high, as we see sort of today, you get lower returns. But I guess, Professor Schiller, you know, the CAPE ratio, we were just talking about this recently, it's 37. It's not as high as it was in 2000 when it was 44.
Right. So it could, yeah, we don't know the future. But we can learn from the past. 1929, the CAPE ratio got up to 33. And people weren't talking about CAPE, but they were talking about price earnings. The market was perceived by a lot of people as overpriced in 1929. And then but there are other periods when the CAPE ratio was fairly high and the returns weren't altogether so bad. So it looks like for a CAPE of 30 to 35, the subsequent returns were about just under 4%.
Yeah,
and then
correct.
the real peak was in 2000 or 1999 or 2000 when the stock market, it was December of 99 when the CAPE ratio reached 44, which was a record high. And you can see that for the 10 years following that, the return was negative.
Exactly, Professor Schiller, and I guess we were just looking at what the CAPE forecasting, and we were just talking about it the other day. It's 4.3, so you know, at least you're going to get a positive return, but it's sort of lower than what we've seen in the last 10 years at least.
Yeah.
You know, I guess, Professor Schiller,
this isn't
how does
disaster.
the CAPE compare to other countries?
Sorry, we both spoke. The 1929 wasn't the disaster that we think it was. If you held on for 20 or 30 years, you did all right from 1929. But there is a difference, and we know when CAPE ratio is high, it is a time for concern. So I wonder, is there a pause?
Thanks. And then I'm going to flip forward to some global CAPE ratios, and I'd love to hear your thoughts on these, Professor Schiller.
You're breaking up. Do others hear him? Well, I can talk about this slide. Do you hear me? Do you hear me?
Still hear you well.
Okay, so this compares 5 major regions and shows their CAPE ratio. In the upper row,
Professor Schiller, do you hear us?
I don't hear you, Lawrence, very well. But if you can hear me, I continue. I hope that it clears up. So the CAPE ratio is very different across different countries. It's not always like this. We're at a period where the USA is especially high. In January, it was 31, and it's gone up even more. Well, it was up over 38 a few days ago. Do you hear me?
I think
I can try switching to another web service. Should I do that?
We're good. So now
I'm trying to.
Apologies, folks. We're having some audio issues here. Professor Schiller, we are able to hear you okay. Lawrence, we are having some audio issues on your end.
Well, it's not for me. I was about to shift to a different web server. But anyway, the CAPE ratio in the United States is not at its highest. And we are going through an exciting period in stock markets, and I'm hesitating to forecast short run. But in the long run, I think it looks like the CAPE ratio is sufficiently high that I would be worried. I am worried about the performance of the stock market in over the next 10 years. Shall I go on?
I can hear you, Professor, well. You're
All
fine.
right, so
I can hear you well.
okay. So the one problem, if you look at comparing across countries, is that different countries have different average CAPE ratios in their stock markets. So, for example, Japan in the 90s, Japan had a CAPE ratio of almost 100.
Professor Schiller, can you hear me? Apologies, I'm going to dial in.
Yeah, apologies, folks. We seem to be having some audio issues here. I think, Lawrence, we've got you back, but we've now lost Professor Schiller. So hopefully we can get him back here shortly.
Okay, great. Let's just, I'm wondering whether I should dial in, but can you hear me okay, Jason?
Yes.
Okay, great. So I'll just maybe pick up on the slide while we wait for Professor Schiller. I think, as we were saying that, we use the CAPE ratio to kind of evaluate if a country is cheap or expensive. Now, what we find is you can't really compare, for example, the United States to the United Kingdom, because the United States is very tech heavy, and the United Kingdom has got a lot of mining companies and consumer goods. So you can't really equate their capes. So what we do is we try and understand if a country is cheap or expensive by looking at its long-term average to see whether, against its own history, to see whether it's cheap or expensive. So, for example, in the United States, you can see that the current average is 37.1, and the last average over the last 25 years, the last 20 years is 25. So that gives us a sort of 1.4, and that's at the very bottom. And then conversely, if I look at the UK, the current CAPE ratio is 17, and its long-term average is about 16. So it gives us a number of 1.08. So that equates that in this scenario, the UK is actually cheaper than the US. And if we look at the other regions, we can see that Japan is also actually quite cheap. And interestingly enough, China, their ratio was about 1.25 recently, and that's actually dropped as we've seen the Chinese stock market has actually dropped recently, and you can see that the Chinese relative CAPE is 0.8. So, I think this also illustrates how we can use the CAPE ratio to find sort of pockets of cheapness. Professor Schiller, can you hear us?
I hear you perfectly now. And
Great,
you hear
and I
me?
can hear you very well.
All right.
I can hear you perfectly. Great. So I think what we'll do, just to sort of pick it up, Professor Schiller, let's move just quickly to discuss how you identify cheap sectors in the US market. And then what I'll do is bring up a slide of the current cheap sectors that we see.
Yeah, well, we look at the GICS sectors, and we compute for each sector the CAPE ratio using that sector's data, and we divide it by the average, as you were saying, to create relative CAPE. You can see that they're a little different. The CAPE, a lot of the variation across sectors in CAPEs reflects the average behavior of those sectors. we want to use the corrected numbers. It's still in the spirit of the original 1980s work I did with Campbell. But when we make comparison across dissimilar sectors, we have to allow for some difference. For example, they might have different stock repurchase tendencies, or the accounting anomalies may affect one sector more than another. So we take a very simple approach to correcting and that we find that relative CAPE performs better than CAPE in making comparisons with returns across sectors.
Yeah, thanks, Professor Shiller. And I think we use the relative CAPE, which is just really the CAPE divided by its 20-year average to see if a sector is cheap or expensive. And what we see is the current sectors that we think are cheap are those one green. And then the blue lines actually indicate the actual CAPE ratio. And you can see, for example, that financials has a low CAPE and a relatively low relative CAPE. But technology is interesting. We've actually been out of technology thinking that it was that little bit expensive, and the CAPE is 53. But actually, technology dropped this month quite substantially, and it looked like it was just one of the slightly cheaper sectors. So we've actually selected that. And right now, go ahead.
It's good to note that we put technology in, so we're not a traditional value product. There is long-standing enthusiasm for technology, especially this is information technology, especially in the United States, which is a world leader in that field. But that doesn't mean that we want to totally stay out of technology. If it's relatively low for its own past, then it becomes a good investment.
Thank you, Professor Shiller. So now I wanted to move on to some narratives. I know you've written a book called Narrative Economics recently, and you're really thinking that narratives are shaping, stories are shaping the way economic outlook. So I wondered if you could sort of give us some of your thoughts on what narratives you're seeing out there that are potentially impacting markets.
Yeah, it's important to look at how people really think. People set these prices, and in some cases, the prices are set by experts. But the decision to invest in the stock market at all is still largely an individual decision, and so it's the swaying of changes in thinking among the general public that matter. What is it that I think if you want to look at how people think and try to understand this, you have to listen to them. And so, what are they saying? Well, they tend to be telling stories. People like stories about people. They like human interest stories. That's the first thing they'll teach you in journalism school. Don't start your article off about statistics. Start it off with a case, one individual case of one family or the like, and tell a heartwarming or a worrisome story. So listening to the story, what have we been hearing about over the last 12 years since the market reached its bottom in 2009? Well, we've been hearing a lot about entrepreneurs who dropped out of college, and like Bill Gates or Steve Jobs, books about their lives. Isaacson's book about Steve Jobs was a huge bestseller. So enrollments in colleges are falling. People want to get into the action, and investing in stocks is an appealing way to do it. They're talking about Robinhood.com. They're talking on Robinhood.com or through Reddit. And so it's generating a party atmosphere. And what are the stories? The stories are not necessarily national stories. They're stories about your friend who got into the market a few years back and has made last year more money than you made working all last year. Those stories wake you up and make you feel attentive. The market looks like a fun place to be in now. Retail investing is soaring in the market. These kinds of stories, and on top of that, there is the deepening concern that many people have or we all have, I suppose, about being left out and being replaced by a machine, a robot or the like. Maybe that's not imminent, but already income distribution is rising, and there's deep concern about that. So what do you do in those cases? You try to join the multitude and be part of what's going on. So buy some tech stocks, maybe. Makes you feel part of it. You're not at war with those people. You are those people. I'm talking in very psychological terms. I apologize to many people who find this unprofessional. It's not unprofessional. It's only unprofessional in the finance department, and less so even there. In the university, we have departments of sociology, anthropology, marketing, folklore studies, and even history that talk a lot about how people think, and psychology. Let's not forget that. I'm just part of the behavioral economics revolution that's been going on for the last 30 years, where we think that we have to learn a little bit more about how those psychologists think about how people make decisions, and then we'll understand markets better.
Thank you, Professor Schiller. I think you've outlined a couple sort of key themes that are driving markets, but then, what is the challenge for the Fed? How do we get out of this stimulatory environment then?
Well, yeah, here's the dilemma that's been faced by every Federal Reserve since the Fed opened its doors in 1914. They're really worried about creating a market collapse and an economic, not just, maybe more worried about GDP and thinking about financial crises as something they want to stay away from. But the problem is that they have to come in aggressively to stop a speculative bubble before it builds. And they feel they don't have the public support for doing that. If you tighten the credit, then you make a situation in which people might lose their jobs. There might be a recession, and you would be blamed squarely for it. You started this. So they tend to be coming in too late. So that's what happened with the great inflation of the 1970s. Arthur Burns, head of the Fed, was just a bit too much of an academic and afraid of starting a war. I don't mean a physical war. I mean a depression. So he just never tightened enough. When Paul Volcker came in, he in 1979, I think it was, he had the nerve to do it. He was a kind of a moralizing type and thought we have to cleanse this country, and the rest of the world has to do the same thing too. He entered a whole new era. He started a whole new era around the world that it created something that they call the Great Recession, 1980 to 1982. Yeah. But we're exactly in that situation again. And does Powell and the current Fed FOMC, do they tighten up and actually enough? There's a question about that. Again, the bias toward keeping interest rates low when times are uncertain is very strong.
Okay, great. So on that point, I mean, are you seeing any signs of inflation? Any inflation narratives? And by the way, I'm showing the wage price spiral graph on screen.
Yeah. Yes. Now, and you're showing money supply. So this must be the growth rate of the money supply.
Correct.
Yeah. It's well, the thing that jumps out is the money stock has grown and more than ever before, except or even beyond wartime in 1945. That's at the far left of the diagram. So something is very unusual going on here with the Fed. They are being very accommodating in order to get interest rates so low. They've had to print a lot of money. Now, I hate to say he might have been right, but Milton Friedman was the most famous economist at the time of the great inflation of the 70s, 80s. He warned that you got to keep your eye on the money supply because it'll eventually get spent. And we're challenging him now. The Fed is trying to see, can we get away with increasing the money supply this much? Times are different, right? Maybe they can, but there is some concern. And the inflation rate is still low, although the latest data have shown a slight pickup. It hasn't happened yet. But I don't mean to base the argument on Milton Friedman's authority. It is that we do have very low interest rates, and people are tending to want to. That has affected the long-term bond market as well, and long-term bond yields are very low because people expect interest rates to stay low. This looks like it might be an unstable situation. What that means for you as an investor is that even holding cash, pulling it out of the market, the stock market and the housing market in fear of a crash, you still might lose because the inflation rate might get big and the real value of your cash would go down.
I see. Do you think that there is an inflation narrative has actually developed yet, Professor Shiller?
Not really. It hasn't gone very far yet. I think that people don't understand the frame of thinking during the 70s when this so-called entrenched inflation that defied Arthur Burns, the Fed chairman at the time. They were very upset about inflation then, and they tended to be polarized about it. There was I wrote way back, it wasn't in the 70s or 80s, it was in 1991. I wrote a paper based on study of interviews of people and what they thought. They tended to think that the inflation was a gross betrayal of the American people, that it's big business is raising prices, and labor unions were suddenly evil in the minds of many Americans because the labor unions were demanding too much and forcing manufacturers to raise their prices for the rest of us. So there were lots of narratives that were circulating then about the greed and the grabbiness of certain people, and it reflected, they thought, in the inflation rate. So that's different than the narrative. Well, it's been put on the back burner. It's not so prominent in our thinking, but it's coming back. I think we might see it come back. We see a polarization in our society now between liberals and conservatives, and it's an unfortunate division that it lowers our trust in each other and makes it more difficult to do business. And so the narrative isn't the same now as it was in the 70s, and it's not as strong. See, what happened in the 70s was that people were very demanding of an increase in wages every year or whenever the contract comes up, because they saw it as other people are being grabby here. I have to stick up for me and my family. So it was hard to cut wages, and it tended to create what they called then a wage price spiral. You don't hear that term so much at the present time.
Great. So Professor Shiller, I'm going to ask you a very tough question because I think it's on everyone's minds, and obviously inflation impacts interest rates, and interest rates really set the tone for a lot of asset prices. So key question today is, do you think this inflation is transitory, or it might actually become entrenched and move higher and stay higher?
I think it might become entrenched and stay higher. but I think it's not clear at this point of time that it really is. We're getting angry narratives, but they tend to be about what's going on in our schools, or with mask wearing, or the COVID crisis, and they've just eclipsed. You can't talk about everything. They've just eclipsed any concern about entrenched inflation. Entrenched inflation back then was based on a theory that that the Fed would accommodate. Arthur Burns didn't have the guts to put the country into a recession, and they were focused on the outrageous demands of labor unions. For example, one of the narratives back then was railroads used to pay their employees on the trains for a day that was measured in miles rather than hours, and but that ended up paying them to work for only 5 hours. And so they would end up sitting down for the rest of the ride because they've gone through their, I don't know if I've got that clearly enough to explain. They thought that the railroad unions were just totally outrageous in their demand. It doesn't make any sense when trains speed up that they would work at the same per mile. So stories like that, or stories about labor, a tour of the factory, and you see a lot of the employees sitting around, and you say, "Why are you sitting down?" And the employee answers, "Because my union gives me a break at this time, and I don't really feel like stopping, but I thought I'd better." That sort of narrative was big time then. We don't see it now. We don't see narratives yet about inflation. But there's lots of people experimenting with new narratives. And when if inflation picks up to a high level, there might be a rebirth of some of these old narratives.
Thank you for that, Professor Shiller. I know a lot of the audience have asked questions on inflation. The other question that we seem to be getting quite a bit of is real estate. What are your thoughts on real estate prices?
Yeah, well, real estate prices have gone up a lot recently. I have indexes that Carl Case and I made years ago. They're now produced by CoreLogic and published by the Standard & Poor. In our latest data, which is for July, the increase in home prices nationwide in the United States was 19.7% over 1 year. That is a record for our index going back to 1987. And it's also a record in real terms. In real terms, the increase in value in 1 year of home prices was 14.7% nationwide. I also have data back to 1881. And the data going way back is a little bit irregular. So I can't say that this is an all-time record, but maybe it's close to that. So why are prices going up right now at such a fast pace in the midst of the COVID epidemic? Well, one reason, of course, is low interest rates. Central banks around the world have been enforcing low interest rates. It's not just Jerome Powell here in the US. It's all over. And so that naturally pushes up prices of houses because the mortgage payment you have to make is lower. And so you feel you can afford more house. So instead of getting more house, you just bid up the prices on existing houses, and then you have inflation of home prices. I think that's what's happening now. What does it mean for the outlook for home prices? In the short run, probably they'll still go up for a while because home prices have been much more inertial. They tend to keep going in the same direction. As you can see from this chart, look at how smooth home prices have been since 2012. 2012 was the bottom of the market after the financial crisis. And both nationally and for big cities, the 20 city index, we see similar behavior. Those wobbles are seasonal. Home prices tend to go up in the summer more than in the fall. But look, the general pattern is accelerating home price increases. So I would expect that to continue for a while, but it may not if there's a financial crisis. And they're getting high relative to construction costs. And that means they're going to be building more houses. So there's also less inclination to live in the center city. And that the houses are in the wrong place.
Yeah.
So they have to build more outside further where people can escape the COVID-19 and other similar epidemics that might come in the future. So I think that it's a risky time to buy a house. I wouldn't splurge. This diagram doesn't show any drops. We should have gone back, I think, Lawrence, back to 2006 or 2005 when the home prices peaked.
Yeah, we would have been able to show more. Unfortunately, this is all the data we can get on the S&P site. But of course, you're absolutely correct that there was a big fall then.
Yeah.
Yeah.
So yeah, I'm thinking that if you really are wanting to settle down now and are valuing a house, maybe you want to do that. They might still go up from here. Looks like it. It's dangerous to extrapolate a trend like this, especially when it's newly strong. I think that what's going on in the housing market is similar to what's going on in the stock market. It's something about the excitement of these times that a feeling there's fear of missing out, and similar that there's fear of being left out of the exciting things that are happening. So a lot of people are making a lot of money in internet business, but you're probably not in that business. So you want to somehow get new and get modern. So buying a nice house, that's the American dream, as we call it. At this time when inequality is going up, you want it in a nice neighborhood, and you don't want them moving in any dangerous criminals like, but you're pretty safe in a good neighborhood, they think. I can't capture what the thinking is exactly, but it's somehow related to their fears of the COVID-19 and their fears of somehow being lost and left out of society.
Fantastic. Thanks, Professor Shiller. So now we've talked about your views on valuations, housing prices, and inflation. You know, sort of just to sort of bring it all together, what are your thoughts on the U.S. economy?
Yeah, well, we had a recession in 2012. It was the shortest recession ever. It was only 2 quarters long, actually 2 months long in a monthly way. So normally we have some space after a recession. On the other hand, that was not a typical recession. It was really a COVID-19 panic. COVID-19 wasn't at its worst in the spring of 2020. It was the scare that was the worst. People thought this was kind of hard to model fear, right? When it was new and people said that we could face 500,000 deaths. And it made people think that the Great Depression is coming again. I know because you can count how often the word Great Depression was used. So it was a narrative in the early stages of the pandemic. Now we have 700,000 dead, and somehow it doesn't seem as worrisome anymore. We haven't controlled the new Delta variant yet, but the narratives are changing, and I would watch the changing narratives to see how vulnerable we are to a recession. It seems like we might actually have a good period in the longer run. I don't know about an immediate recession, but the economy was shaken up by COVID-19, and we're learning certain things about what we can do differently. So the thought of having a business that asks people to show up at the office only 2 days a week. Had anyone heard of that theory before 2020? now it seems like a good thing to do, right? I mean, no need to battle traffic every day. You can have your meetings 2 days a week. So this may be this and other things it may not help GDP, but it'll help human welfare. So the auto industry may face a decline if people aren't commuting as much. On the other hand, maybe we'll be happier.
Great. Thank you, Professor Schiller. So I think that concludes our moderated questions, and now I'm going to go through to some questions from the audience, and I see we've got a couple, so thank you very much for that, everyone. So, I guess one of the first questions I have is someone's asking, Professor Schiller, if you could give any advice to the advisors out there, what would that be?
Oh, advice to the Fed or to
the advisors and insurance?
The financial advisors.
Correct.
Well, the usual thing I like to say, I'm an academic. I teach finance. I have, by the way, a free online course on Coursera. But I like to emphasize diversification. The theory, don't put all your eggs in one basket. That term, by the way, goes back to the 1870s at least. But it has always been considered rather boring and unexciting stock market advice. So don't try to find the next Apple and put all of your savings into that. Well, one good thing about real estate as an investment is you're buying something that you know and like, and you can use. It would be a risky play. When was it? 20 years ago, when you could have put all of your money into Apple stock, and that would have been that would have made you rich. But don't do it. Don't try to do it. But I don't think there's anything wrong with putting the bulk of your portfolio diversified across sectors, across countries, and across asset types. And then having some fund stocks that you are investing in, that you have a hunch about, as long as they're a minor part of your portfolio. And hey, if you get another Apple corporation, then you'll find out that you are rich, pretty rich anyway.
Great. Thanks, Professor Schiller. I like that. Got a question from Michael Gorman, who says, kind of interesting observation. He said he's found that 3 consecutive reductions in the monthly CAPE may indicate a market fall. He wonders if that's a coincidence or if you have any thoughts on that.
Well, yeah, there is momentum in the stock market, and so this may be a momentum trade when you say that. In our products at Barclays, we do incorporate a momentum filter, and that has helped. So if stocks go down for 1 or 2 quarters, that might be especially true in housing. If home prices start falling, that's that's an important sign. So I think that's maybe what you're getting at here. There is a little momentum in stock market prices. So that's what the random walk theory was supposed to deny. What happened before 1980 in academic finance, is they were thinking that stock prices are a random walk. I mean, they have no momentum. If they go up 10% today, what do you predict for tomorrow? Nothing. Or maybe not that they'll go down or go up, they'll just be average. That was the random walk theory. But then careful research showed that it's neither extreme. The market has some momentum, especially over 12 months to a year. And then it keeps going in the same direction. And that is exploitable. That's not new. A lot of money managers are doing that.
Great, thanks for that, Professor Schiller. Another question is, do you worry about stagflation?
Stagflation is a word that was invented around 1970, or in the 1970s, during the Great Inflation, and during the recession of 73, 75. That recession also had stagflation means high unemployment and high inflation at the same time. So no one had ever thought about calling it stagflation before, because they didn't see that, they didn't have the idea that the Fed was stabilizing, and that they ought to be able to do that. And it was a surprise when the Fed had trouble in the 70s, creating with moderately high unemployment. We still had inflation, and Paul Volcker had to slam on the brakes and encourage other countries to do the same thing to conquer the inflation, the great inflation of the 70s. So are we? That could come back. I could see if you look at the dot plot, which is the forecast of the Federal Open Market Committee at the Fed, they are thinking of raising interest rates. Not this year. About half of them think they'll raise them next year. It's really 2023 when they think they'll have to raise them. So they may create a stagflation environment, and the question is, where do we go from there? If they start raising rates and unemployment goes up and inflation doesn't go down, they might get timid again. So their dot plots is only some indication of what they might do, and you have to outguess the Fed to figure this out.
Fantastic, thanks for that. We've had a couple people ask about your thoughts on Bitcoin. What do you think about Bitcoin and cryptocurrencies?
Well, first of all, Bitcoin is a fun idea. It's actually a cool idea. I think it comes to mind especially when you are dealing with your passwords on your various accounts. Doesn't that become, for many of you, a real nuisance? Remembering, they keep telling you got to change it for some reason or another after you had it memorized. So you want to get on top. Young people today worried about their futures want to get on to something like Bitcoin. It's just a great idea if it could be true. And it makes them feel freed from the vagaries of government. It's particularly attracted by people who are who have the anarchy impulse. The term anarchy goes back to the 19th century as the philosophy that we don't need much government. Let people do their own thing and it'll all come out better. It's now called libertarianism, I suppose. These are in growth. So the founders of Bitcoin, you can see this on the website, have anarchic tendencies. They think the government can't tax this. They can't take it away from us because they don't know my password. They don't even know what I've done. They don't know who I am. They don't know how to connect the password with the name of me, my name. So I think, though, that it's a flawed idea at this present time, and there might be some inspiration that will come from it for something good. It's been driving central banks to create their own digital currencies. We might see more of that, but it wouldn't be so anonymous. And it's not clear that they can't be taxed. They can demand that you declare the income with penalties. And so you probably will declare it and pay taxes on it. But I think that it's an example of a narrative epidemic, as I discuss in my book, Narrative Economics. The story is just too cool. I notice when I'm lecturing to my students at Yale, and I mention Bitcoin, and I see them waking up in the back of the classroom. They love Bitcoin. It inspires a sense of I can master this. I can master all these passcodes, and I'll be on the in crowd that's making a lot of money doing this. And one thing I particularly like about the Bitcoin narrative is that it was claimed to be invented by a man named Satoshi Nakamoto, who cannot be found. Can you believe this story? I think it's true. This is not a false narrative. Satoshi Nakamoto made an appeal to a blog of computer jocks and asked them if we could start Bitcoin. And you can see his initial papers still up on the web. But so they started Bitcoin without ever having met him. And when Bitcoin became so famous, people wanted to interview Satoshi Nakamoto, and they said, "We don't know. We've never met him." And then Bitcoin fake Satoshi Nakamoto start to appear. Anyway, it's a story that's very tellable. The quality of story matters a lot, and even wars can be started. For example, Harriet Beecher Stowe wrote Uncle Tom's Cabin. It's a great book in 1852, I think, and it led to the Civil War because it was so divisive. The same thing can happen again. We have to watch these narratives coming up and see what the next presidential candidates say and what other people are saying through time. Bitcoin, I think, is flawed, but I'm still a little bit sympathetic. I'm not investing in it. Something like that might help in the future.
Great, thank you. We actually had a lot of questions on Bitcoin, so it's great to hear your views there. You know, we're probably going to take a couple more questions, but I think we probably won't be able to get through all of them. But thanks to everyone. But Professor, oh, sorry, go ahead. Is that you, Jason? No. Professor Shiller, what are your thoughts on COVID-19 and how this is going to impact the real estate market? Any thoughts there?
Yeah, well, first of all, it has dynamics that are unfamiliar to economists. Most recessions are not caused by disease epidemics. I can think of only one other. It was in 1918. There was a short recession associated with the influenza epidemic of that time. But a Bitcoin epidemic is really different. So what is the out? I'm not sure whether I've answered your question.
No, that's fine. It was let me pick up another one. I'm just trying to combine a lot of questions here. We sort of got one of the questions. We've had a bunch on interest rates and low interest rates. What's the impact? And what are your thoughts on low interest rates? And are they propelling these sky high valuations?
Yeah. Okay. Well, we really have had low interest rates lately. Last summer, in 2020, I mean, the 10-year Treasury rate fell to 0.52%, a half a percentage point a year for 10 years. This was at a time when the target inflation rate for the Fed was 2% a year. That target inflation rate made for negative expected returns. So we have the lowest interest rates, 10-year or long-term government bond yields back to 1871. It has never been this low. So we're living in really anomalous times. Why are people pricing new Treasury 10-year securities at a negative real return? It's also in other countries. We have TIPS, Treasury Inflation Protection Securities, that are inflation indexed, and they're trading at a negative rate. So why is that? It has something to do with faith in the Fed, I suppose. I'm thinking that the popular narrative is that the Fed rescued us from the last recession, big recession, was 2007, 2009. That's also called the Great Recession by some people. So they kind of think the Fed is going to keep doing that, even though their own dot plots, the Fed's own dot plots, put the 10-year Treasury above 2% in a few years. It's driven by fear of, there is fear of a stock market crash. I know that I have survey data. There's fear of 1929, which kind of went away. The story was in early of 2020, there was a theory that the COVID crisis would would launch a Great Depression. But we seem to have gotten away from that for now. So we're not fearful about the economy. And that, of course, helps boost the economy. We're not wearing masks as much. I don't know, I've noticed even here in New Haven, there's a lot of people going around with no masks. They haven't quite told us to taking them off indoors, but people are doing that anyway. So there's a spontaneous recovery of optimism that might drive the economy further. I kind of like to compare this with the end of World War II. After World War II, economists made a mistake of predicting a return of the Great Depression after 1945. But the Great Depression didn't come back. In fact, it was boom times after 1945. So if you look, what were people thinking after the World War II, which was a kind of epidemic, a human epidemic? What were they thinking? I tell you what they were thinking. They were thinking, I need a vacation. This has been horrible. Let's just live a little. Let's just have fun together. So the term victory vacation came out. Everybody wanted to take a vacation, and they wanted to travel all the way to Florida for a big vacation. And it was just exhilarating. That mood developed around narratives of people having fun again. I think we might have that. That could come on, and it could produce a strong economy after the COVID-19 is under control.
Like a roaring 20s in a way.
But, yeah, those were the roaring 50s, but the roaring 20s came after the influenza epidemic and after World War I. It's hard to pin down which was more important, the end of World War I or the end of COVID-19, but they were similarly timed.
Thanks, Professor. And I guess, one sort of further point from me that, you and I earlier, we wrote a paper where we looked at what we called the excess Cape yield, where we sort of effectively took a Cape yield less interest rates. And what we found that because interest rates are so low, it makes equities much more attractive. The fact that actually bonds are just a bit more overvalued and you have to put your money somewhere. So we kind of postulated that that might be one of the reasons we've seen some of these elevated capes as well.
Yeah, so you can diversify in many ways, and that includes foreign investments, and it includes commodities, and you could buy a summer home. Some people do.
Great. Well, Professor Schiller, I think that takes us to the top of the hour. So I really wanted to thank the Athene team for organizing this event, and especially to all the advisors who've joined. I really appreciate that. And then Professor Schiller, lastly, I just want to thank you very much for your time today. It's been wonderful to hear all your views on a wide range of topics.
Yeah, it was fun for me too.
Great. Thank you, Professor Schiller. Good afternoon, everyone.